Okay, think about this for a second. A single share of Berkshire Hathaway back in 1980, it cost about $275.
Right.
Fast forward to, say, mid-2024, and that same share, over $630,000.
It's an absolutely staggering number.
Incredible growth.
Yeah.
And it's not luck, right? It comes down to a very specific, very deliberate investment approach, mostly from Warren Buffett.
Yeah, and what's really striking is how, well, steady that growth has been. It's built on these principles that often seem completely counter to the market's, daily noise.
Definitely. Buffett is basically synonymous with value investing, long-term thinking.
But for you listening, trying to grasp the core of his success, what are the real, essential takeaways? What
Yeah.
truly matters?
That's our goal in this deep dive. We want to unpack the key ideas behind Buffett's investment philosophy. Pull out the insights that have, driven those amazing results.
Yeah, give you a clear path to understanding what makes his strategy so different, and maybe even how it could shape how you think about business, about investing in general.
It's not just about trying to copy his returns, is it?
No, not at all. I mean, understanding his framework gives you this fundamental lens, a way to evaluate businesses, understand what they're really worth, and just appreciate the power of, well, sustained economic growth over time.
So we'll cover the basics, the foundations.
Right. Value investing, long-term thinking, then maybe some intermediate stuff like valuation, economic moats.
And even get into the structure of Berkshire itself, maybe some recent moves.
Exactly. The whole picture.
Okay, let's dive in. Starting at the beginning,
Mhm.
value investing. What's the absolute core idea here?
Well, at its heart, value investing, and you have to mention Benjamin Graham, his mentor, it's about finding companies where the stock price seems unjustifiably low,
Lower than what, then?
lower than their actual underlying worth, their intrinsic value. A market, it sometimes gets things wrong, misprices companies for all sorts of reasons.
Okay.
And that gap, that difference between price and true value, that's the opportunity for the value investor. But, and this is crucial, Buffett isn't just looking for any cheap stock.
Yeah.
It has to be a discount based on a really rigorous, independent assessment of that intrinsic worth. Not just because the price dipped. That discipline is key.
So it's much deeper than just looking at stock charts or ticker symbols. It's about thinking like an owner.
Exactly. For Buffett, buying a share of stock isn't just a blip on a screen. It's like buying a small piece of an actual operating business.
The fractional ownership.
Precisely. And that completely shifts your focus. You stop thinking about short-term market guesses and start focusing on the long-term health, the potential of the underlying company.
And he has a great analogy comparing the market's short-term versus long-term behavior. Something about voting and weighing.
Yes, that's such a core concept for him. In the short run, he says, the market is like a voting machine. Popularity, sentiment, fear, greed, they can push prices all over the place, sometimes irrationally.
Makes sense?
But over the long term, it acts more like a weighing machine. The true fundamental value of the business, its earnings, its assets, its prospects, that's what ultimately determines the stock price.
So the trick is patience.
Patience and conviction. You need to wait for that weighing process to happen, even when the voting is going crazy.
Okay, so focus on the substance, ignore the noise. And that leads us right into this idea of a margin of safety. Sounds really important.
Oh, it's fundamental. Absolutely critical. The margin of safety is basically the cushion. It's the difference between what you estimate the business is really worth, its intrinsic value, and the price you actually pay for its stock.
And you want that difference to be big.
You want it to be substantial, yes. You're aiming to buy at a significant discount to your calculated intrinsic value.
He uses that analogy, the bridge analogy, right?
Yeah.
To make it really clear.
He does. It's very vivid. He says it's like an engineer designing a bridge. You build it to hold, say, 30,000 pounds, even if you only ever expect 10,000-pound trucks to cross it.
That extra capacity.
That's your margin of safety. It protects you if your calculations are a bit off or if something unexpected happens. Same idea with stocks. Buying cheap provides a buffer against mistakes or bad luck.
So even if you find a fantastic company, you still have to be careful not to overpay. He's very blunt about that.
Extremely blunt. He's famously said, what is sensible at a discount to business value becomes stupid if done at a premium.
Right.
You could identify the best business in the world, but if you pay too much for it, you limit your upside and, more importantly, you increase your risk of actually losing money permanently.
Okay, so buy with a margin of safety, focus on the business itself.
Yeah.
When he's looking at these businesses, what specific things is he analyzing? What fundamentals matter most?
He's really digging into the underlying health. Things like consistent earnings power, strong profit margins, how much profit they keep from each dollar of sales.
Debt levels.
Absolutely. Manageable debt is key. And he puts a huge emphasis on what he calls durable competitive advantages.
Okay, durable competitive advantages. That sounds like a core Buffett concept.
It really is. It's this idea that a truly great business has something special, something that protects its profits from competitors over the long haul.
Like a moat around a castle.
Exactly his term, an economic moat. It could be a powerful brand name people trust, a unique technology, maybe a significant cost advantage that others can't match.
And these moats are crucial for that long-term profitability he wants.
They are essential. And notice what he doesn't focus on. Market charts, price volatility, beta.
Beta. Explain that quickly.
Beta is just a measure of how much a stock price tends to move compared to the overall market. High beta means more volatile.
And Buffett ignores it.
Largely, yes, because his focus is decades, not days or months. Those short-term swings are mostly irrelevant noise if the underlying business is sound.
So it's all about understanding the business deeply, staying within his circle of competence.
Precisely. He hammers this point home. Only invest in businesses and industries you genuinely understand. If you can't explain how it makes money, who its competitors are, what its future looks like, you probably shouldn't own it.
Makes sense.
He's even said, look, if you understood a business perfectly, the future of a business, you would need very little in the way of a margin of safety.
But perfect understanding is impossible.
Exactly. So stick to what you know. He tends to like simple, understandable businesses, companies that reliably generate cash.
And all of this, the value focus, the safety margin, the deep understanding it all feeds into his famous long-term perspective, doesn't it? He's not in it for a quick buck.
Not even close. His advice is legendary. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes.
Wow. 10 years minimum.
That's the mindset. He actually sees market downturns, panic selling as opportunities. Chances to buy more of those great businesses at even better prices.
He wouldn't mind if the stock market closed for a few years.
He's literally said that. If the quotes disappeared, it wouldn't bother him because he's focused on the business's long-term compounding power. He trusts that eventually that weighing machine will reflect the true value.
Okay, that covers the foundations really well. Value investing, margin of safety, business fundamentals, circle of competence, long-term view. Let's move up a level. These intermediate concepts, starting with intrinsic value. How does he actually figure out what a business is worth?
Right, intrinsic value. It sounds complex, but the idea is quite logical. Buffett defines it as the discounted present value of all the cash that can be essentially pulled out of a business over its entire remaining life.
Okay, discounted present value. That means you have to estimate future cash flows. Sounds tricky.
It absolutely involves estimation, judgment. There's no magic formula that spits out the exact number. In practice, you're trying to forecast reasonably how much profit or cash the company will generate in the future.
And then bring it back to today's value.
Exactly. You discount those future amounts back to their present-day equivalent. Use a discount rate that reflects the risk involved. As Buffett put it, intrinsic value is a present value estimate of the cash that can be taken out of a business during its remaining life.
So it's more about getting the direction right than the precise number.
Very much so. It's about making sensible, conservative estimates of that long-term cash generation, not getting lost in, calculating things to the third decimal place. Is this likely to be a $10 billion cash generator over time or a $1 billion one? That's the kind of thinking.
And didn't Berkshire used to have a specific target for growing its intrinsic value?
They did. Back in, I think, 1993, he mentioned aiming to grow Berkshire's intrinsic value by about 15% per year. Now, specific targets might change, but that core idea, striving for significant long-term growth in the underlying worth that remains constant.
And earlier, he followed Graham's stricter rules.
Yeah, early on, following Graham, he looked for cigar butt type situations, stocks trading way below their net current asset value. But he acknowledges those easy-to-find statistical bargains are much rarer today.
Okay, so calculating intrinsic value, even roughly, is key. And that brings us back to margin of safety again, doesn't it? They're linked.
Directly linked. You need that estimate of intrinsic value to know if the current market price offers a discount. The margin of safety is that discount. It's the buffer between your estimate of value and the price tag.
And the less certain you are, the bigger the buffer you need.
Exactly. If you're analyzing a complex business or one facing a lot of future uncertainty, you need a much wider margin of safety. Back to the bridge analogy, you build in more protection.
Because you can never be perfectly sure about the future.
Never. So even if you think you understand a business really well, some margin is always wise. It protects you against the unknown and your own inevitable mistakes in judgment.
And this discipline applies to things like stock buybacks, too.
Absolutely critical there. For Buffett, a company buying back its own stock only makes financial sense if that stock is trading below its intrinsic value.
Otherwise, you're just overpaying for your own shares.
Precisely. You're actually destroying value for the remaining shareholders. He keeps repeating that mantra. What is sensible at a discount becomes stupid if done at a premium. It applies whether you're buying whole company or just buying back shares.
Okay, let's circle back to those economic moats. We touched on them, but let's explore them more. What really makes a moat wide and durable in Buffett's eyes?
Right, the moat. It's that long-lasting competitive edge that shields the company's profits. Remember the quote? Seeking a business with a wide and long-lasting moat around it, surrounding and protecting a terrific economic castle.
So what forms can these moats take? You mentioned brands.
Brands are a big one, yeah. Think Coca-Cola, American Express, global recognition, customer loyalty built over decades. That's incredibly hard for a newcomer to replicate.
What else?
Significant cost advantages. Maybe a company has unique access to raw materials or incredibly efficient operations, allowing it to undercut competitors on price while still making good profits. Think Geico's low-cost insurance model, perhaps.
Network effects.
That's another powerful one, where the service becomes more valuable as more people use it. Credit card networks like Amex or Visa are classic examples. The more merchants accept it, the more useful it is to cardholders, and vice versa. Switching costs can also be a moat if it's difficult or expensive for customers to switch to a competitor.
So these moats act like barriers, keeping competitors out and profits in.
Exactly. A wide, deep moat makes it really tough for rivals to attack the castle and steal the treasure, so to speak. And that long-term protection is why Buffett might be willing to pay what looks like a slightly higher price for a truly great moated business.
Because those earnings are more predictable, more sustainable.
Precisely. The moat underpins the predictability of those future cash flows that are central to his valuation. It all ties together: the quality of the business, the moat, the valuation, the margin of safety.
Okay, and when he's looking at the numbers, the financials, what are the key metrics he zooms in on?
He definitely has his favorites. High and predictable returns on capital are huge. Is the company using its money effectively to generate more money?
Return on equity.
Yeah, historically he's mentioned aiming for something like 15% return on equity, ideally without using too much debt. Strong, consistent free cash flow is another big one.
Free cash flow, remind us what that is.
That's the actual cash a company generates after it pays for all the investments needed to maintain its business, new equipment, buildings, etc. It's the cash left over that's truly available for owners.
Got it. What about growth?
He likes to see steady, predictable growth in both revenue and profits, maybe in the, say, 5–10% per year range, ideally compounded over long periods. Consistency matters more than explosive, unpredictable spurts.
And he cares a lot about what management does with those profits, right?
Oh, absolutely. Are they smart capital allocators? Do they reinvest profits wisely back into the business where they can earn those high returns? Or if not, are they good about returning cash to shareholders?
Through dividends or buybacks?
Exactly. Either dividends or share buybacks, but again, only if the stock price is attractive, below intrinsic value. While Berkshire itself doesn't pay a dividend preferring reinvestment, he often praises companies that do, especially those that consistently grow their dividends.
So key metrics might include return on equity, free cash flow yield, debt levels.
Yep, free cash flow yield, that's the free cash flow per share relative to the stock price, gives you a sense of the cash return. And definitely keeping an eye on debt ratios to ensure the company isn't over-leveraged. It's about profitability and financial strength.
Okay, fantastic. We've built a solid understanding of the core and intermediate ideas. Now let's get into the really big picture. Berkshire Hathaway itself. How does Buffett apply all this on such a massive scale? Let's start with the insurance float. It sounds kind of technical.
It is a bit technical, but it's also a cornerstone of Berkshire's success. The float comes from their insurance businesses, Geico, National Indemnity, others.
How does it work?
Well, insurance companies collect premiums up front, right? But they don't pay out claims until later, sometimes much later. That money they hold in the meantime, the premiums collected but not yet paid out, that's the float.
Okay.
For Berkshire, this float is enormous. In 2023, it was nearly $169 billion. Think of it like a huge pool of capital that Berkshire gets to invest for its own benefit before it has to pay out claims.
So it's like an interest-free loan.
Essentially, yes. As long as the insurance operations are run well and underwriting results are decent, meaning premiums roughly cover claims and expenses over time, it's very low-cost, long-term funding. It's a massive advantage.
And this fuels their investments.
It's a huge part of it. This float, combined with the earnings from all their other businesses, creates this unrivaled mountain of capital, as Buffett calls it. By early 2025, their cash and treasury bill pile had ballooned to over $334 billion.
Wow, that's just a staggering amount of cash. What does he do with all that?
Well, that's the beauty of it. He has incredible flexibility. When he sees a great opportunity, maybe buying a whole company outright or loading up on a stock he thinks is undervalued, he has the firepower to act decisively, often when others can't.
And if he doesn't see opportunities?
Then he's perfectly happy to let the cash pile up. He won't force investments if he thinks prices are too high across the board. He'll just sit patiently, holding that cash, waiting for the fat pitch, as he likes to say.
Now, Berkshire isn't just stocks and cash, right? They own entire companies.
Oh, yeah, that's a huge part of the structure. Berkshire is really a conglomerate. They own dozens of wholly owned businesses in all sorts of industries.
Like what?
Well, the BNSF Railroad, a massive operation, See's Candies, a classic brand, Jayco, of course, lots of utilities and energy businesses, Fruit of the Loom, Dairy Queen, the list goes on.
And these usually have those moats we talked about.
Many of them do, yes. Strong economics, durable advantages. And typically, Buffett buys these companies and lets their existing management teams keep running them with a lot of autonomy. He focuses on the big picture capital allocation.
So these owned businesses provide steady earnings.
Exactly. They generate a consistent stream of earnings that flows up to the parent company, contributing significantly to Berkshire's overall intrinsic value and providing even more cash for Buffett to allocate.
Okay, turning to the part people often focus on. Berkshire's stock portfolio, it's famously not widely diversified, is it?
Not at all, especially compared to typical mutual funds. It's highly concentrated. As of late 2024, they held positions in maybe only around 38 different stocks. The total value is huge, like $267 billion, but spread across relatively few names.
And the top holdings dominate.
Massively. The top 5 historically, that's been companies like Apple, American Express, Coca-Cola, Bank of America, Chevron. These 5 alone recently made up something like 64% of their entire stock portfolio's value.
64% in just 5 stocks. Why such concentration? Isn't that risky?
Well, Buffett argues the opposite, in a way. His thinking is, why spread your money thinly across hundreds of companies you only feel okay about? If you find a few truly exceptional businesses that you understand deeply and have high conviction in, why not bet big on them?
So concentration forces deeper thinking.
That's his argument. He said concentration may well decrease risk if it raises the intensity with which an investor thinks about a business. If your money is heavily weighted in just a few places, you're going to be extremely diligent about understanding them inside and out.
It makes sense. Focus on your best ideas. Now, even Buffett tweaks the portfolio sometimes. Any significant recent moves we should know about, say, from 2024 into 2025?
Yeah, the big one recently was trimming the Apple stake significantly. They held a massive position, almost 790 million shares at one point.
Huge.
Yeah, it was like half their stock portfolio. But they cut that down considerably to around 300 million shares by early 2025. That dropped Apple's weight from around 50% to maybe 22% and obviously generated a lot of cash.
Any idea why? Taxes, valuation?
He hasn't explicitly detailed every reason, but valuation likely played a role after Apple's strong run. It also reduces concentration risk. On the buy side, they made some smaller, more modest additions. Little bits added to Domino's Pizza and Pool Corps steady, understandable businesses.
And they sold some things, too.
Yes, they completely sold out of their position in D.R. Horton, the home builder. The stock had run up a lot, and it seems they just weren't willing to hold it at that higher price. Classic Buffett discipline, don't overpay.
It really reinforces that value discipline, doesn't it? Even when a sector looks hot. And he's always warning against trying to predict the market's next move.
Oh, constantly. He'll tell you straight up, forecasts tell you nothing about the future. He believes even the smartest people can't reliably predict market turns. Just focus on the businesses.
Okay, let's talk about returning capital. Berkshire famously doesn't pay a dividend. Why not? And how do they return value to shareholders then?
Right, no regular dividend. The core philosophy is that Buffett believes he can generate better long-term returns for shareholders by reinvesting Berkshire's profits back into its existing businesses or by acquiring new ones rather than just sending the cash out as dividends.
So compounding within the company is the priority.
Exactly. However, they do return capital through share buybacks, but, and this is the crucial caveat we keep coming back to, only when they believe Berkshire's own stock is trading below its intrinsic value.
Is that discipline again?
Always. Sensible at a discount.
Yeah.
Stupid at a premium. They spent nearly $26 billion on buybacks in 2023 alone, which tells you they saw value in their own shares then. Buffett's even quipped that Berkshire stock is his favorite stock when the price is right.
So it aligns management's actions with shareholder value. Finally, let's talk about maybe his most famous rule, avoiding losses. How central is capital preservation to everything we've discussed?
It's absolutely paramount. Rule number 1, as he says, never risk permanent loss of capital. Rule number 2 is don't forget rule number 1. It underlies everything. The focus on quality businesses, the margin of safety, the long-term view, avoiding businesses you don't understand. It's all geared towards minimizing the chance of a significant permanent loss. He prioritizes safety over chasing the highest possible return if it involves taking undue risks.
And that seemingly conservative approach led to that incredible growth we started with.
Exactly. That journey from $275 to over $630,000 per share wasn't achieved by taking wild gambles. It was achieved through disciplined investing in great businesses bought at reasonable prices and letting compounding work its magic over decades, all while rigorously avoiding major blowups.
Stick with the winners.
Yeah, as he said, when you find a truly wonderful business, stick with it. One wonderful business can offset the many mediocre decisions that are inevitable. Find something great and let it run.
So boiling it all down. Buy quality, buy it at a fair price or less, hold it for a very long time, be disciplined about how you use cash, and above all, don't lose money permanently.
That's a pretty good summary. It sounds simple, but the execution requires immense patience, discipline, and that deep business understanding.
Okay, so for you listening right now, what's the single biggest takeaway from this whole deep dive into Buffett's world?
I think the main thing is realizing that while the principles buy good companies cheap, hold long-term sound easy, actually doing it consistently takes real discipline. It requires patience when the market is going crazy, and it demands a genuine focus on understanding the business, not just the stock price.
Yeah, it's about long-term value creation, not short-term speculation.
Absolutely. It's easy to get caught up in chasing hot stocks or quick gains, but the question is, how do you cultivate that patience, that ability to ignore the noise that Buffett exemplifies?
That's a really practical question,
Oh,
and
yeah.
maybe a final thought for you to chew on. In this world that seems obsessed with instant results and daily market swings, take a sit back. What durable economic moats do you actually see in the businesses you interact with every day?
Yeah, think about it. Not necessarily for investing, just observe.
Yeah. Right. Apply those ideas of long-term value, intrinsic worth, competitive advantage. Just think about them in your own world. It's a different way of seeing things.
It really is. And look, understanding these core ideas is just the first step. If this sparked your interest, definitely dig deeper. Explore value investing more. Learn about financial analysis. Read about other successful long-term investors. There's a lot more out there.
Definitely. Well, thanks for joining us on this deep dive.
My pleasure. Thanks for listening.